All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our weekly options recap. Wanted to do a little bit something different here today as we wrap up the week. We normally like to come in, walk through some of our trades that we closed out here this week. We also typically take a look at some of the newer trades that are on our radar for next week. But I also want to spend some time talking through why we use so many vertical spreads. I've had so many questions come in here over the past few weeks. Mike, why do you look at vertical spreads so much? Why not trade long calls and long puts? I'm going to walk you through why we use the spreads, how we use them, and why I personally believe they should be a part of everybody's trading. All right, so we'll go ahead and get to that topic in just a moment. Let's start out by talking through just some general market thoughts here as we go into next week. It's another week of some very key levels tested. If we go back to yesterday's session, this is the daily chart of SPY. This is the S&P 500 ETF. Look at the low of the session. It tested those support levels almost perfectly. Those yellow lines there, those are the 50-period simple moving average and 50-period exponential moving average. We found support right there, almost to the tick, and have since bounced higher. If we go back and take a look over the past few months, anytime that we have tested those moving averages, look what it's led to, right? If we go back into late January, tested that level, got a springboard move up to all-time highs. We then saw another test early March, found some support. It wasn't a clean test there. I mean, it took a couple of days, but look what that led to. Found support there, found another move up to the all-time highs. Here we are again. We found support yesterday, trying to move back higher here. We've already seen price break above the pink line. That's the 8-period exponential moving average. So it does look like the market wants to make another run higher here going into next week. The all-time high is up at 398.12. You can see that from a couple of weeks ago. Ultimately, I do expect that 400 level to be tested here before we get a significant sell-off. We've seen it this week. Any round of selling that we have had has just led to more sector rotation, and it just prevents any type of significant weakness from kicking in. I do expect us to get one more push to the upside. Once we test 400, I think that's going to be a huge battleground. I do expect us to see a more significant pullback off of that level. So we'll see if that plays out. Going into next week in the near term, a couple of areas to watch. Obviously, the moving averages that we just talked through, the 8 EMA, the 50-period EMA, and SMA, those all act as support levels going into next week. So we'll want to watch those closely. Should we get another fall back to the downside? On the upside, if we do get this rally to continue, we've got 395. It's a level that I'm going to keep an eye on. And then ultimately the 398.12, the all-time high, if we do continue to move higher. So those are some levels, some key points of interest going into next week. The volume has been pretty good. I mean, we've been between 80 and 100 million shares pretty much the entire week. So it's been an active week as far as volume goes. I want to see that continue. Obviously, the higher the volume, the easier it is for us to get fills on our trades. The ATR, it's been hanging in there just above 5. It's a good level. What we talked about last week is I don't want to see this thing continue to trend lower. If we start to trend lower and break that 5 level, it's just going to mean there's not as much action to work with intraday. It's going to be a more difficult environment to work with. I want to see things stay active. I want to see things move back and forth. I want to see this ATR stay above 5. So that's another level that we're going to be watching going into next week. Now, one of the other index products that we like to look at is the Russell, symbol IWM. This is the Russell 2000 ETF. This one, we've seen this one lag. It led the charge starting the year. It was really the strongest name on the board. And now over the last couple of weeks, we've seen a really healthy pullback. And this one has been up until the last couple of days. It has certainly been lagging behind some of the other markets. Well, we did come down. We did find some support right on top of the moving averages here with those blue lines. Those are the 89 EMA and the 100-period EMA. Found some support right on top of those levels. And we've tried to bounce. Saw a really nice push higher yesterday. We're seeing the Russell up another 1% today. So we've seen a nice bounce in the way that we played this. Coming into yesterday's session, we knew the Russell was oversold. We were expecting a bounce because we've seen how many times over the last few months, we've seen this game of rotation where you get the NASDAQ, leading, the Russell lags, and then they flip-flop. They pass the baton. And we were expecting the Russell to try to find some support to try to bounce higher. And now we're starting to see that here just over the past 24 to 48 hours. So what we did yesterday afternoon, we did take an overnight pop trade. Let me get over to the trade page and we'll talk through it. Many of you have seen us review this trade in these recap sessions. It continues to be a really great performer for us. We did end up breaking our 20 trade win streak earlier in the week, which was unfortunate. I'll talk about that more in just a moment. But we were able to follow it up with a nice winner here this morning. So what we did yesterday afternoon, we like to take these overnight trades, typically around 3:30 Eastern time, about 30 minutes before the market closes. That way we can take advantage of the better volume late day. It also allows us to see, are there any head fakes or any false breakouts during the middle of the day as well? Well, knowing that the Russell was strong all afternoon yesterday, we closed right up near the highs. We came in and we sold an out of the money put spread. We were utilizing the options that expire today, the March 26 options. We came in and we sold the 215, 213 put spread. All that means, if you're not used to trading vertical spreads, all it means is we're trading two options at the same time. We're selling the 215 put and we're buying the 213 put at the same time. Now, on this trade yesterday, we ended up getting filled around 57 cents. We collected $57 per spread. It left us with $143 of risk. That was the capital that was required to put the trade on with one spread. So a very reasonable trade, very low cost trade. You could certainly trade it with multiple spreads. I did so myself personally. We can certainly bump up that position size and still keep our risk at a manageable level. Ultimately, we wanted this stock to stay above 215. We made money if it moved up, down, or sideways. Didn't matter to us. As long as IWM stayed above 215, we were okay with regardless of what it did directionally. All three scenarios were okay for us. We also made money from the time decay, and this close to expiration, the time decay is extreme. So we're looking to take advantage of these options losing value going into expiration just solely from that time decay adding up. And then we also made money if volatility decreased. So we had 5 ways of making money on the position. We made money the fastest if IWM opened to the upside. That's exactly what happened here today. Okay, this morning we saw a higher open and we've basically moved higher the entire session. We've seen very little selling pressure here so far today. We ended up closing out of this spread first thing this morning. Within the first 2 minutes of the market open, we ended up closing out of the spread for 14 cents. We bought it back for 14 cents, booked a really nice profit, around a 30% return on our capital overnight. Phenomenal. We love that. Now, you can clearly see down at the bottom, it's now trading for 3 cents. Had we held into this afternoon, we could have made more money. The problem with that is had we not seen this market move steadily higher all day, what if we reverse back to the downside? We could have seen this trade quickly go from a nice profit to a decent sized loss. These are very, very active options when you get this close to expiration. So we ended up closing it out. Let me bring up my spreadsheet so you can see the numbers here. And let's go to the overnight pop trade. So this one right here down at the bottom, this is our trade. We sold it for $57, 57 cents per spread. Closed it for 14 cents. It gave us a $43 profit per spread. It's a 30% return on our capital in and out in less than 24 hours. Love this type of a trade. So for the week, we closed out of 2 winners and we had 1 loss. The loser came on Wednesday. We sold a call spread on SPY on Wednesday. We ended up closing out of the trade mid-morning and we ended up taking a 10% loss. Now, it was a smaller loss, right? So we want to keep those losses as small as possible. That way we can recover much quicker. The tricky part about Wednesday is had we held into the afternoon, we would have made money on the trade. It would have ended up turning out to be a really nice winner for us. I do not like to hold these trades into the afternoon if I don't have to. Okay, because I don't want to run the risk of letting a losing trade turn into a full loser. I'm okay taking a 10% loss because I can recover much quicker. If I let this trade turn into a 100% loss, now all of a sudden it's going to take a couple of winners to battle back. So hindsight's always 20/20. We can always look back and say, hey, I should have held the trade longer on Wednesday. I could have made money. But long term, it's going to be in our best interest to try to keep those losses as small as possible. And you can see here, 2 winners and a loss this week. Yeah, we don't like to see that red on the performance spreadsheet. But even with that loss, we still made money from the overnight pop trade. So that's why I love this setup. It continues to perform really well for us. So yes, we did break our 20 trade win streak. All good things must have come to an end, right, at some point. But we were able to follow up that loss with a nice winner to wrap up the week. So it continues to be a great performer for us. We'll continue to look for trades here each and every week. SPY does have those Monday, Wednesday, Friday expirations. So we will actually be looking for another overnight pop trade this afternoon for Monday's expiration. So potentially having another opportunity here going into the end of the session today. All right, let's talk briefly about, let's talk about the vertical spreads in more detail. I just touched on it briefly with our IWM trade that we closed out this morning. But I want to talk about this in more detail because we use them so often. And we have a lot of newer traders that have joined our team that are newer to the whole idea of trading vertical spreads. So I wanted to review some of the basics here so you know why they are powerful, how we use them, and why I think you should add them as soon as possible as well. So when we talk about a vertical spread, all it simply is trading two options at the same time. Right, we're buying an option, we're also selling an option at the same time. It helps create a defined risk position. We can either buy the spread or we can sell the spread. If we're buying the spread, it's known as a debit spread. If we're selling the spread, it's known as a credit spread. We trade far more credit spreads because when I sell a spread to open up a position, it gives me 5 ways of making money on the trade. If I buy a debit spread, it's very similar to a long call or long put in that I only have 1 way of making money. That stock has to move in my favor, and it's got to do so relatively quickly. With a credit spread, now I put the time decay in my favor. I give myself multiple ways of making money, and it becomes a much more forgiving type trade. So we trade far more credit spreads than debit spreads on our side. So ideally, we like to buy the spreads when volatility is low and when we want to just make a pure directional bet. If I have a strong opinion on whether the stock is going to move higher or lower, I don't mind using a debit spread. We like to sell the credit spreads when volatility is high. When the volatility is high, the options are more expensive. It gives us more premium to collect on those types of trades. We will use the credit spreads when we are looking for a higher probability of success. We also know that we are taking a lower potential return, a lower profit potential on the trade. So there's trade-offs. There's a time and a place for both. But again, the credit spreads for me are going to be more powerful. They stack the deck in our favor. Now, why is that? How do I get 5 ways of making money on a credit spread? When we take a look at the pricing model of an option, let's do that here right now. There are 6 inputs that go into the pricing model of an option. You've got stop price, strike price, time to expiration, volatility, interest rates, and dividends. All 6 of those inputs go into the pricing model to give us the current option price. Now, thankfully, we don't have to do that math. Our broker platforms do it for us, and they give us the actual option price. But I wanted to point this out because so many people get focused on this top input, purely looking at whether the stock price is going to move higher or lower. Now, that's fine, but you have to understand there's also other inputs that can impact the performance of the trade. If you buy an option solely expecting the stock to move, it's got to move big enough to offset some of these other inputs. We've got to offset the time decay. We've got to offset potential volatility movement against us. You have to have more to go right in your favor to make money when you buy an option. Not a deal breaker. I will buy options from time to time, but I also want to make sure I'm trading a fair number of credit spreads because they give us a much higher probability of success. The ones that I want to focus in on here for a moment. Time to expiration. If I go back a slide, this is a graph showing the time decay of an option. If I start to go out 40, 50 days towards the left side of this graph, the time decay is still there. Those options are losing value every single day, but it's not as big of an issue when you start to go out farther in time. As we start to get closer to expiration, every day that passes, once we start to get inside of 20 days left to expiration, look how this curve really starts to drop off a cliff. The time decay really starts to pick up significantly. This is what we're looking to take advantage of. With a credit spread, we actually make money from the time decay working in our favor. Every day that passes, that's a good thing. That works in our favor. And we, especially with the overnight pot trades, we're looking to take advantage of this right here. That time decay is just absolutely extreme when you start to get 24 hours out before expiration. Okay, so this is what we're looking to take advantage of. We're looking for that time decay to work in our favor when we use a credit spread. Now, let's talk briefly about the bell curve. I've touched on this in recent sessions. When we talk about the bell curve, some of you are numbers people. Some of this might look familiar to you if you're into statistics, if that's part of your job, for example. It probably looks familiar to you, but others, this might be a brand new concept. And the bell curve takes a look at all occurrences. It could be, in this case, the movement of a stock. It could be applied to sports or other businesses. Basically, it's taking a look at all occurrences, and we're saying from a statistical perspective, 68.2% of all occurrences are going to fall inside of this dark blue range. So a majority, 2/3 of all occurrences, are going to fall inside of a defined range when we take a look at any type of a stock. Well, that's good to know, but it's even better to know that it's still possible to have those extreme moves on the upside or the downside. If we start to go out between 1 and 2 standard deviations, it's this lighter blue section right here, we know it's possible. It's just not statistically probable because only 13.6% of all occurrences will fall outside of this range on the upside and outside of that range on the downside. It gets even more extreme the farther out that you go. If I start to go out between 2 and 3 standard deviations, now only 2.1% of all occurrences fall outside of that range on the upside and outside of that range on the downside. If you go out past 3 standard deviations, now only 0.1% of all occurrences fall outside of that range. The reasons that's powerful for us is when I sell a credit spread, I'm looking for stocks or ETFs that are at extremes. I'm looking for markets that are at 1, 2, 3 standard deviation moves because I know when those happen, in all likelihood, we're probably late stage in a move. Because over time, 68.2% of all occurrences are going to fall in this middle section. If I get an extremely overbought stock here that's at a 2 standard deviation move, I know that only 2% of all occurrences fall outside of that range. In all likelihood, going forward, price is going to want to gravitate back towards that middle section. If a stock is overbought, it's going to want to consolidate or start to sell off. It has to get back to that middle section over time. So I'm taking that and I'm trying to stack those factors in our favor by using a credit spread. So let's take a look at a trade that we put on yesterday. And let me go ahead and pull up my spreadsheet here. I'll show you the chart and then we'll walk through the why behind the trade. It was a trade on Snapchat, symbol SNAP. We came in and we sold an out of the money put spread. Specifically, we sold the 48 put and we bought the 46 put at the same time. We are using the April 16 options. Those are the monthly options with, what do they have now? 21 days left to expiration. When I sell an out of the money put spread, a lot of times people see put option, they think, hey, it's a bearish position. It's actually not. If I were to buy a long put, absolutely it's a bearish position. But because I'm selling a put spread, it's actually a neutral to bullish trade. I actually want this stock to move higher. And I make money as long as the stock stays above 48. Let's talk about that in more detail. Let's break it down. Let's start with the chart here. Let me flip the chart over to Snapchat. Like I've talked about in previous sessions, I like to use either the 195-minute or the 130-minute chart. That's my preferred time frame for a swing trade. Now, the indicator down at the bottom, that red and yellow histogram, it's what we call our pulse histogram. And we've talked about this in previous recap sessions where when it starts to plot yellow like this, it indicates that price is between a 1 and a 2 standard deviation move on the downside. In other words, we're oversold. So this yellow representation right here, if I bring back that bell curve, we're between a 1 and a 2 standard deviation move on the downside. So if I apply the bell curve, only 13.6% of all occurrences fall outside of this range on the downside. We're in this section right here. Does it mean it can't head lower? No, it could certainly head lower. It just means it's not statistically probable because we know over time, going forward over the next couple of days, couple of weeks, price is going to want to get back towards this middle section where 68.2% of all occurrences fall. If I'm expecting that stock to move from this light blue section to the dark blue section, I want to lean a little neutral to bullish. I'm expecting the stock to either consolidate or start to bounce to the upside. Now, if I'm expecting to move higher, why not just come in and buy a long call? Right? It would give me a bigger profit potential. If I buy a long call, it's fine if you have a very strong directional outlook. The negatives to that is it's going to tie up more capital. It's more risk. And that trade only gives you one way of making money. You have to see that stock move to the upside. With a short put spread like we put on yesterday, now all of a sudden I tie up less capital. I give myself 5 ways of making money instead of 1, and it's a more forgiving trade. Okay, so the whole idea behind the setup yesterday that we sent out to our NASDAQ customers is the market was oversold. we are banking on either a consolidation phase here or even a bounce to the upside. Okay, so let's go over to the trade page. I'm going to show it inside of Thinkorswim here. Let me get that trade out of there. And let's go ahead and bring up Snapchat. And we'll go ahead and open up the April 16 options, the ones with 21 days left to expiration. So again, from our spreadsheet, we sold the 48-46 put spread. So to put that trade on inside of the platform, I'm going to go to the 48 put. I'm going to right click on it. I'm going to go to sell, and I'm going to go to vertical. That is going to pop up an order down at the bottom where I am indeed selling the 48 put. And then from our alert, we said we wanted to buy the 46 put. Why am I buying the 46 put? If I were just to come in and sell the 48 put, take a look at this. I would click $1.81. But my maximum loss on the trade, okay, it's actually $4,600. I don't like the risk reward ratio. Can I make more money just selling a naked option? Sure. It's far more risk. I don't like that scenario, especially in today's market when we see so many headlines hit. They hit overnight during the Asian session or the European session. I don't want to get caught with large amounts of risk and then face a large loss. So instead of just selling the 48 put on its own, by turning it into a spread, look what it does to the cost of the trade. We go from tying up over $4,000 of capital to with the 48-46 put spread, we're tying up $143. That's my maximum loss in the trade. If I am dead wrong, only 13.6% of all occurrences will fall outside of this range on the downside. But if that's what happens here, what if we get one of those outlier moves to continue? The most I can lose on this trade is $143. I'm better able to manage my risk. Can you take this with multiple contracts, multiple spreads? Absolutely. If you've got a bigger account size, you put the trade on with 10 contracts or 10 spreads. You still, in that case, only have $1,400 of risk. And again, to take that a step further, if I have $143 of risk on this trade, the only way I lose the entire $143 is if I hold all the way up to expiration. That is not something we like to do. We can always close the trade out early and take a partial loss if we need to on a trade that moves against us. Now, here's where it starts to get fun. Remember, if I buy a long call here on Snap looking for the stock to move higher, okay, I only have one way of making money. Ties up more capital, more risk, lower probability of success. With this trade here, I have 5 ways of making money. I don't care if the stock moves up, down, or sideways, as long as it stays above the short strike, the 48 put that we sold. The stock is currently trading for 51. I have over a $3 cushion where this stock could continue to move dead against us to the downside, and I'm still okay. The only move that hurts me is a move below 48, which I'm not expecting because the market's already oversold, which we just got done talking about. So up, down, or sideways, we're okay. The time decay is working in our favor. Every day that passes, remember what we talked about with that time decay graph, every day that passes, that works in our favor. It helps us. It causes the options to lose value. That's exactly what we want to have happen. And then we also make money from volatility decreasing. Those are the 5 ways of making money on the position. So the whole idea on this trade is I want to sell it to open up the trade. Okay, I'm selling this spread, in this case for 57 cents or $57 per spread. And the whole idea is I want to buy the spread back cheaper over the next few weeks and pocket the difference. So if I buy it back for 20 cents, for example, 2 weeks from now, I pocket the difference between what I sold it for to open it and what I buy it for to close it out. So it takes a little bit of a transition in your thinking. Most people think, hey, I want to buy an option and I want that thing to increase in value. We're actually making money from these options losing value. We want to be able to buy the spread back cheaper over the next couple of weeks. Okay, so if we get filled at 57 cents, the $57 per spread is my maximum profit. The only way I'm able to book that maximum profit is if I, is if I hold all the way to expiration. I don't typically hold to expiration. I want to close it out when I can keep between 50 and 75% of the max profit. So if I can buy this thing back for between 14 and 28 cents, that would allow me to book 50 to 75% of the max profit. Okay, the most I can lose, again, is $143 per spread. Some of you might be looking at that ratio saying, okay, you're risking between 2 and 3 to make 1. How does that make sense? It makes sense because we have 5 ways of making money. Okay, we're going to have a very high winning percentage over time. With our NASDAQ service, over the last 320 trades, we've had a 73% win rate. Our overnight pop trades, we've had 21 wins and 1 loss in the last 21 trades. You're going to have a very high winning percentage on these types of trades. So I'm okay risking between 2 and 3 to make 1. I can make those numbers work. What I can't make work is if you start to risk between 6 and 7 to make 1, the numbers just don't play out. So you've got to make sure you keep your risk reward in check. Most people struggle. Most people have a bad idea of what a credit spread is because they think it's too much risk, right? I hear that all the time. Hey, it's too advanced, it's too much risk. It's actually not. But then also people will go for those trades that have a 90% chance of making money. And then they're risking 6 or 7 to make 1. That just doesn't work over time. If I can have a 70% win rate and I'm risking between 2 and 3 to make 1, I can make those numbers work. On the overnight pop trade, right? We had a losing trade this week, a 10% loss. When the losses happen, I can recover much quicker. And I'm banking on the fact that the numbers are stacked in my favor. I'm going to be able to make money over time as I continue to build my sample set of trades. Right? So that's the reason why we like to use the credit spreads. Where most people get frustrated, I've talked to probably 10 people this week alone that have struggled with their options trading. And when I dive in and ask them what they've been doing, they talk about trading just long calls and long puts. I'm not opposed to trading those strategies as long as it's only part of your portfolio, because more often than not, we're going to have markets that are indecisive. We're not going to have markets making historic moves all the time like they've done the last 12 months. It's not realistic to expect that. More often than not, you're going to have markets that are bouncing around. They're noisy. With this type of a trade here, I don't need to be perfectly right on direction. If the stock moves higher, great. I want to make money faster. If it doesn't, if we just chop sideways, I'm still able to make money from that time decay working in our favor. So it's a more forgiving trade. You're going to see a higher probability of success. And for me, quite frankly, I think it's easier to handle psychologically. When I know I don't have to have every little factor line up in my favor, I'm able to trade with a much higher level of confidence. Not to mention, you're talking about tying up $140 of capital. So you're just going to be able to take a larger number of trades and still keep that risk at a reasonable level. Greg, been with Pop for 1 month. Great job, Michael. Appreciate the feedback, Greg. Thank you for submitting that, and glad you're able to take advantage of the trades. It has been a really great stretch for us, no doubt about it. These markets, I talk about this quite a bit. The ideal market for an options trader is the back and forth movement. Okay. The dreaded environment for me is the one-way market. Whether it's a one-way market higher or lower, it doesn't matter. I just don't like it. There's not as much that we can do. When you start to see things bounce back and forth over time, we get to take advantage of this. We're taking advantage of the back and forth movement. We're looking for overbought conditions, oversold conditions, and we know that this bell curve, there's so much power in these numbers. Okay, when I start to take a look at our trades, a lot of it is based off of this pulse indicator right here. It's so powerful. I don't look at what analysts are saying. I don't look at what CNBC, Bloomberg, Fox Business. I don't care what they say. It doesn't matter to me. I am banking on focusing on those numbers, getting the numbers and statistics in my favor, focusing strictly on price action. It's my opinion that all of the news, any type of a headline that you can imagine, is going to be baked into the stock price quicker than you can even react. Right? If the Fed makes an announcement, okay, if the president makes a statement, back when Trump was in office, when Trump released a tweet, the markets reacted so quickly to that news, it really didn't even matter. You didn't need to read the headline. If you're focusing on price action, it's all priced in almost immediately for us, and we can react based on price. We can ignore all of the other noise out there. I can't tell you the last time I had CNBC on. It's been years. I don't pay attention to it. I don't want to be distracted by the noise. I want to focus strictly on price action. So that Snapchat trade, we ended up opening the trade yesterday. We got filled at 60 cents. I just showed you the spread trading for 57 cents. That is still a trade that you could take. So the position that we just walked through on Snapchat, definitely one that's on my radar. I definitely like it. I do think the market is going to give us a deeper pullback here in the weeks to come. But in the near term, I want to have some trades in both directions. I want to have that diversification because ultimately no one knows what the market's going to do next. We could break higher or lower from here. No one knows. So I want to make sure I have a good mix of trades on so I can react quickly to whatever the market throws our way. All right, so hopefully you found this session beneficial. The last couple of weeks, I know we've had a lot of you join us live and watch the recordings. And I've had some feedback. Mike, why do you always talk about the credit spreads? Hopefully today starts to paint a picture for you for why it's so powerful, why it's so beneficial. As always, if you have any questions at all, feel free to email me directly. Mike@netpicks.com is the email address. If you're watching the recording on YouTube or Facebook, you can certainly leave a comment there and I'll get back with you right away as well. So looking forward to next week. Absolutely. We've had a great stretch of market action. So we'll hit the ground running here on Monday. I'll be back on Wednesday next week for our next midweek recap. If you have any questions between now and then, feel free to contact us directly. Again, Mike@netpicks.com is the email address. So I'm going to wrap up this session for today. Enjoy your weekend, everybody, and we'll talk to you guys again next week.